So Nick, how did you get that the nickname, the fixed income goat? Super interesting.
So I'm actually celebrating very much. I'm as shocked as anyone here, but this is my 20th year in real estate. I started very early on. I had, I was always trying to be entrepreneurial and entrepreneurial minded. And so I just wanted to be around people that were just killing it and achieving huge amounts of success. What I saw was people a lot on the tail end of that. They had made a lot of money in the entrepreneurial space and they were figuring out that transition. So some of it was family, some of it was friends, some of it was just friends of friends or friends of, extended. And so I wanted to be as close to those people as possible. And they all seemed to be doing real estate. It's as simple as that. I just said, they're being successful. How do I be closer to that? So I navigated towards that direction and got to learn a lot from what would come to be known as family offices. At the time, they would never call themselves that. And ultra high net worth individuals, they would never call themselves that. But I learned a lot of sophistication by working for free or for very little. And along the way, the 2008 financial crisis happened and we started going to town. And so I really leaned into the acquisition side of things. And we were buying a lot of foreclosures. We were buying huge amounts of distressed assets, sometimes REOs, and we were focused on the asset side, the property side. And what ended up happening was when we were buying these assets in distressed situations, banks would also go, hey, we also have these distressed mortgages. And I'm like, no interest. We're asset people. We want to buy these assets at discounts. We have the money. We were typically buying up to $10 million a week. So we were big buyers that got banks' attentions. They're like, no, you have to take a look at these mortgages. And eventually we took a look at some. I took a look at some at the time. Eventually there's some really good opportunities where I started compiling these in conjunction with our portfolio as it grew, just kind of on the side and as kind of a hobby and as an additional asset class, because we knew the foreclosure process. So worst case, we'd end up with the assets back. So that's a long answer to the fact that we ended up with a lot of mortgages. We found out there were many advantages to investing on the debt side of real estate as opposed to only the equity side. Meaning, most investors, they invest as an LP, a limited partner in a fund or a syndication, and they're pretty hands-off, right? That's usually an equity position, whereas there's also the opportunity for investors to invest on the debt side, which has so many advantages, especially in a market cycle right now, that I had friends kind of razz me a little bit and just kind of give me a hard time because I was like, fixed income. It's something that most people need in their portfolio that they don't have. So fixed income goat, it's equal parts kind of like a funny term from, between friends, as it is to be very clear that we focus quite a bit on fixed income right now.
So Nick, kind of going back a little bit, right? Because you've been in this industry for well over 20 years. When you talked about when you first got started, you said that you wanted to surround yourself with people who are doing bigger, like thinking a little bit differently. What was it about like your upbringing and how you were raised, or, like the surroundings that you had to lead you to start thinking that way? Because not everybody automatically, has those same types of thoughts as they're growing up, especially as a young person.
So I love that question. It's actually really close to my heart. My family is an immigrant family from Italy. That's our background. So there's an immigrant mentality that we've held on to very strongly, even over multiple generations, of work yourself to death, and that you owe it to your family, you owe it to your children, you owe it to your parents and your grandparents to achieve more and do better than they did, right? So in my family, that's very, very, very core to our expectations of each other and ourselves. So that's how I was raised. My grandpa went from being essentially a farmer and an immigrant from there to moving forward to owning, retail restaurants. My dad jumped forward and created a large company that he was very successful in. It's my job to continue moving that forward and learning as much as I can from, friends and family and people that had done amazing things. So that's what it is. It's that core. And so seeing different people and success along the way, whether it's friends, family, or people in an extended network, I just wanted to be close to that. I saw that there were a lot of zeros at the end of things that they were doing. They were making decisions differently based on a longer time frame, a larger strategy, a bigger picture that I saw most people not going towards. So I just said, I don't really care what it costs me. I don't care if I work for free. I'll figure out how to survive along the way. The goal is to learn that with the understanding that there's a bigger goal. There's a lifetime project ahead. I now have a whole bunch of kids, and I try to give them the same mentality. I started working at 12. They'll start working very early as well. That job will probably suck, and their goal is to figure out how to raise themselves up from there. So that's kind of the mentality that I was raised around, very entrepreneurial, with high expectations around that too.
I can totally resonate as well, because my family also comes from an immigrant family. My parents also immigrated here to the United States. They came from a war-stricken country, had to build themselves up also from the ground up. One thing I want to ask though, especially being from an immigrant background, I think a lot of times for those families, they're pushed to a point where they have to build something for themselves here in this country because they don't have anything. So the only way that they know how to do it is hard work. Let's just work as hard as we can. Let's push ourselves to the limit, to the maximum as much as we can. But at the same time, they don't necessarily have the knowledge because they weren't born here, they weren't raised here, to know the difference between like working hard, but then also investing at the same time until maybe later in life. How did you start developing, the difference between just working hard, but then also at the same time building wealth later on?
I have a really bad answer to that question. I'll be honest. I did the opposite. I worked my tail off to the point where everything from health issues, relationship, I just leaned all the way into work. So I didn't have that answer for a long time. But here's what I did know for sure, because you hit the nail on the head, is that there's a whole work-life balance was not a whole big discussion. That was not an idea in my life growing up. It was work and you survive, right? And then if you work really hard, you survive and your life's a little bit better for yourself and your children. So on my side, I tried to, there's an old quote, I played hockey for many years, so forgive me, from Wayne Gretzky. And he says, don't go to where the puck is, go to where the puck's going, right? Look ahead, see around the corner, see around the bend of what's coming up. And so I saw the entrepreneurial side. I knew that was what I had to do, and I knew that was meant for me through and through. But I also saw what people did after they sold businesses or after they worked so hard. What did they do with the money? Let's say they were successful, 95% are not successful, but the 5% that are successful, of small business owners beyond 5 years, they do something with that money. And usually it's investing. And so I'm saying, well, when you're successful, you invest, is there a way to just go to the investment side and learn what those guys are doing? Because they already have success. That's how they got to that place. So if I could learn the skills and I could learn the investment strategies. So that's kind of the route I tried to take, was just skip ahead to where everybody's already really successful and be around those individuals. There's some really smart ones. If I could learn how to invest like they do and manage businesses and manage portfolios like they do, then I could probably understand how to find the money after that fact. So that was my route, was just break down what they're doing and skip ahead to wherever they were successful. Try to learn that piece of it.
So how did you end up breaking into this group, this network of people who are doing what you wanted to do? How did you find them? How did you get connected with them to get started on, your growth in your business?
Oh man, again, it's going to be a less glorious story. I wish I could tell you this amazing, just slam dunk story and I knocked it out of the park. The honest to God truth is I got a lot of really bad no's. Okay, so I had somebody that I now refer to as an uncle. He's not, that's just like a family term for somebody with a deep respect for them. And he was somebody that was very close to my family growing up. And he was second generation real estate investor, very successful. And I just said, hey, can I take you to lunch? I have a couple questions, right? And I kind of tried to backdoor and say while we're at lunch, I'm like, I want to work for you. I just want to learn. Listen, I said, I'll work for free. And I thought that was the absolute biggest offer that I could make, free labor, free value. And he's like, oh, Nick, I appreciate it. You're overpriced. I can't afford you, right? I'm like, what else do I have to offer? I didn't even understand the calculus in my mind wasn't even there of what else I could offer. And he just said, this is a crazy time in the market. We have a lot going on. I literally cannot afford to put time, energy, or focus towards your career. And I was like, oh, I was young. My heart was broken over that. So what I did was I said, I'm pissed and I'm not going to take no for an answer. And so I went to all these different real estate investment clubs, all these different ones, probably a dozen of them over and over and over, and compiled lists of people that wanted to invest and added them to a newsletter. Hey, here's some value, that I could add during this time. And I went and took that list and I brought it to him and said, I have like 550 people that want to buy real estate right now in this dicey economy. And your brokerage side of your business is starving to death. So let me trade this list just to sit on a desk with a phone for free and drink coffee around your team. And he was like, okay, you're not going to go away, and you brought me some value, so fine. We'll give you a desk in a crappy corner of a crappy back office. And I just sat next to him all day long. And every day I just sat there, whatever he was doing, I was trying to listen, I was taking notes, I was running errands, and I had to barter my way in for free because I couldn't get hired for free. Here's the cliff notes of how much that I had no value to add somebody who's very successful. But I learned exponentially amount. He's a dear friend to this day that I would do anything for him and his family.
See, the difference is, when you become that successful person, you see wealth and money in a little bit different perspective, because it's not only about the dollar amount anymore. Now the time is the precious commodity here, and he didn't have that time, which is so precious and valuable to him, to spend it on you. But I love the fact that you had found a way to bring value to him and not be forgotten and have no for and take no for an answer. But it's like, hey, here's a list of 500 investors. What can I do for you? And then you found a way to show him the value that you could bring.
That was all I knew, was marketing. And like, if I could build a list, that was all really only, I couldn't add value asset management. I knew that. I couldn't raise anything for money. I was too young. Nobody would have trusted me to hand millions of dollars over. So what could I do? The only thing I could do was offer to figure out a way to boost the top line. And the other cool thing about really wealthy people is, if you bring them opportunities to make more money, at the very least, they respect you for that. So that was the only thing I could figure out. And thank God it worked, because I owe him a lot.
So Nic, you've been in the market for so long. You've seen the 08, 07, you've been in a couple of different market cycles as well. How does that compare to where we are today? Because you've been on both the asset purchasing side, and you've also now are in the business of the debt side of things. What are the differences between the two that you're seeing in today's market?
Fantastic question. So today's market's interesting because it's in 2008, nearly everything was bad, right? There was top to bottom across the economy, there was a collapse of all things in the financial sector. You had massive financial institutions that were decades long, many decades of being an institution being wiped out overnight, chopped up and sold to, the lowest bidder, basically. Today's not like that. It's a weird time today that we're in. Now we're in the post-COVID world. So there's, this cleanup of inflation that we're dealing with, but we also printed over 40% of every US dollar in existence in the last several years. That's a weird dynamic, right? On the flip side of that, we have the tail end of the baby boomer generation as far as the workforce goes. They've had the most success, the most wealth, and the largest size of any generation in US history, and they're transitioning out of the workforce. COVID sped that up in a big way, in an interesting way. We have, over and over and over. There's so many dynamics that are good and bad that have like many pluses and minuses. Like, for instance, on the inflation side, the other half of inflation is that the economy is doing amazing by most of the metrics. The jobs that we expected month over month actually were double in the last period that was tracked, right? So while that's inflationary, because there's more jobs, it's not a weak employment market, it's a pretty strong employment market. The other side of that is it's boosting inflation. So the Fed's in a position where they're actually raising rates because there's parts of the economy that are overheated, and there's also super inflationary pressures. So as a core foundation of the economy, I think the economy is extremely strong. As the core fundamentals of inflation go, I think inflation is not going anywhere for an extremely long period of time. And we are very far away from sorting that out. So economy good, I have a bet on that. inflation really not in a good place. So the question is, what do you do with assets in that environment? In 2008, to me, it was the perfect time to purchase property. 2008, 2009, all the way to 2015. I mean, there are many deals still lingering in through the market. Right now, it's a different, there's a different calculation for that. A lot of what we're seeing, the adjustment of the pricing of things is due to the rates, right? Because you can't justify having a 4 cap if your rate's a 7 or an 8 or 9 or, these crazy rates. It just doesn't pencil out the same way anywhere near that. So why take that degree of risk in these market conditions? So what we've done is we've leaned more into the mortgages that we've been purchasing over the years. We put together a big pool of 500 plus, like you mentioned. And instead of having this high, low distributions might come, they might not, like many equity investors are dealing with right now, we went the opposite route. With so many wealthy, high-level, investors on our side, they said we want something that we can depend on with a fixed rate of return. So what we did was find dependable assets that we can put together to deliver a very fixed rate, a higher rate of return than they'd find anywhere else, and then the flexibility to get out of the investment pretty much when they needed it. So we leaned into what our investors were asking for very heavily. Again, I'm a huge property advocate. I love property. We're very heavy on the industrial side. We just don't see the timing there right now for what we look for on the property side. Whereas the fixed income side, there's just so many advantages and availability of things today in the market that we feel that the cost benefit analysis of that is very high.
So what are the other asset classes that you're focusing on then?
Over the years, we've done everything from development, entitlement focused, changing of zoning, industrial, office, retail, multifamily. We've done everything over the course of the years. What we found we were most successful at is simplifying into 2 asset classes at a time. That's it. And we make our bets on 2 asset classes, looking at the economics of both. So on the property side, we focus heavily on industrial, almost exclusively on industrial at this stage, and we narrow down to just several markets. On the fixed income side, it's single family residential mortgages. So if you think about, middle America, middle class, white picket fence, 3-bedroom, 2-bath, family occupies the house. It's not some investment property in the middle of a speculative market. That's what we're looking for, is a very middle of the fairway mortgage where we can purchase that mortgage, we can portfolio it for decades and have consistent payments. That's really, exactly what we're looking for in this market.
So then in today's market, since you're focusing on primarily the single family residential and the industrial side of the business, is that going to change on how that impacts your strategy going forward in the upcoming future here?
Great question. I don't see that changing. What we look for, I don't see that changing for the foreseeable future. We're looking for, we do the barbell approach, like I said, fixed income being that we can usually beat the market on a fixed income basis. So somebody could expect, with very high likelihood, we've never missed a distribution, that they can get a set rate of return on one side. And then on the other side, we look for a growth side. So fixed income and growth. We're looking for one asset class of those categories. So on that said, industrial, as we see it, is the best appreciation growth play in the US for what we look at the fundamentals. And the mortgage sector, the US single family residential mortgage sector, is the best fixed income play we're seeing today over a long term. So with that horizon, I don't see anything changing for how we calculate deals for a little bit.
Where do you see, I know we don't have a crystal ball or anything like that,
Sure.
But based off of your expertise and what you've seen in the past market cycles, where do you see, or where do you think that the market will end up kind of shifting to over the next, year, 2 years? Because there's a lot of fear right now about everything's going to crash. We're going to go back into like what happened in 2007, 2008 timeframe. What is your perception or your take on it?
What we're seeing in the numbers, we spend an obscene amount of time on the economics of things, because after I saw in 2008 what was going on, and then the fundamentals and the quantitative easing and all these huge dynamics, and eventually people figured out phrases like, don't bet against the Fed, don't go against the Fed, right? Things like that, where we learned, along the way. What I'm seeing today and what we're looking at on a longer term basis is really to lean more into those sectors, because I think the strength, the fundamentals are there beyond anything else. What we're seeing is that most rates that were locked in over the last handful of years are in that 3, maybe 4% range. I think it's something like over 80% of mortgages, 82% of mortgages are in a locked in state for 30 years at a 3 or 4%. That is a substantial amount where there's a lot of stability in that marketplace, right? So I don't see a disruption there. Here's the disruption I see in the marketplace. I don't think high rates are going anywhere for a long period of time. I absolutely don't see that in the cards, because I think, again, good economy for the foreseeable future, but with inflation being high, I do not see Jerome Powell at all whatsoever moving away from the mandate from the Federal Reserve of 2%. Everybody's patting themselves on the back. Everybody in the finance sector has been, hey, inflation seems to be curbed. Hey, it's pretty much solved. Hey, and I'm seeing these like very positive headlines, and I'm like, who's not positive right now is Jerome Powell, and he's still saying we have a long way to go. So we've seen the highest increase of rates at the highest trajectory in the shortest period of time in history within the US. That's what we just went through. It's amazing that our economy is doing as good as it is, so let's compliment the economy for that. On the flip side, if you're looking at the numbers, let's start with consumer price index, which is what we typically look at as inflation. Even with all the progress we've made from 9% inflation in mid-2022 to today, which is in the 3s, we're still seeing the last CPI number, the consumer price index number, the measure for inflation. We're still seeing the CPI go up, the last numbers that were reported. Now, if you take a look at the CPI, there's leading indicators. There's things that add into the CPI that are leading indicators of what's going to happen. We're seeing the PPI, the producer price index, the manufacturers and the people that produce things, they have gone up in price even more than the CPI. So downstream, the CPI looks like it's actually still potentially continuing to increase. I see inflation sticking around. The new norm, kind of to answer your question directly, the new norm that I see is high rates. Historically, I think, don't quote me on this, I'd have to jump into some numbers that we were looking at previously. I think rates averaged around 5.6% over the last 100 years or so in the US. That means we're pretty much closer to the norm. If we had 3 and 4% rates the last few years, and now we're at 6, 7, 8% rates right now for different sectors, some in the 9s and 10s and the crazy stuff, we're right around average for the last decade of low rates, right? So all that to be said, I think that changes how everything's calculated on the purchase side. I think that changes how everything's looked at on the equity investing side, purchasing properties. And we're underwriting to that on every deal that we're looking at. Also, rent growth in many sectors. There's these really rosy figures that were being bounced around when people were looking at deals, and that's changing quite a bit from what we're doing in-house. And hopefully what I'm seeing out in the market also is most syndicators and most funds are being much more conservative as well. So long-term higher rates. How high? I don't see them going backwards anytime soon. I think they'll probably post up around these levels until we start to see 2s in the CPI to the consumer price index. I think Jerome Powell is very focused on that 2%. I think he's smarter than most people give him credit for. He takes a lot of crap from the finance space. I think he sees that there are some really big inflationary trends on the horizon and that we need to keep that ticking down, even if slowly, to make sure that we're ahead of any issues. I don't see rate drops for a long period of time.
What are some of the other tools that you're utilizing? Maybe just give us another 2 or 3, because there's probably several that you're using right now to kind of stay on top of the market trends and all the states and the changes that are being happening, because they're moving so quickly, it seems.
Sure. And so a couple other things. I take notes on this all the time. So I'm pulling these up now. I'll give you exactly what I'm looking at, a complete look under the hood. So we're in industrial. So I'm looking at manufacturing a lot in the United States. I'm looking at a contraction in the most recent numbers in the manufacturing PMI, down 2%. Not good, right? But on our side, on the flip side of that, if you're in the industrial space, that's actually a good thing. That means there's it can be looked at as a good thing excuse me, let me get my words together. It can be looked at as a good thing if you're in the right markets, because a lot of markets are on the upswing. It shows that inefficient things like supply chains, where a manufacturing plant in the middle of nowhere is not as strategic as a plant placed well in distribution lines near shipping hubs, like in your backyard, Eileen, the Port of LA and the Port of Long Beach. Between those two is 40% of imported goods in the US. So do you want a warehouse really far away from that, or do you want a warehouse really close to that, right? So I look at numbers like that, what's going on with manufacturing in the US. I'm looking at employment. I'm seeing that it was double what expectations were for the last reported period. That tells me what the jobs market in the US looks like, just an overall gauge of health of the US economy. I'm looking at credit, consumer credit numbers, because we operate in the debt space. We purchase mortgages, right? So if we're buying mortgages, which is buying into a secured asset class in the debt space, what's happening with people's credit cards? What's happening with people's medical bills, right? We're actually seeing a good number, which is that a decrease in the amount of consumer credit, meaning people are paying off their credit cards, they're paying off their bills positively in the right direction. We've been hearing the opposite lately. So that's a good trend, that people are actually trending down. Those are, I'm looking at 17 pages of my most recent economic notes, but those are some highlights just to give you a quick insight of what we're looking at most recently.
Thank you, Nic. So, Nic, how has real estate investing impacted your life?
I really like this question. I will say that at a stage of my life, real estate really, I'll just say it just short of saved my life. I was running multiple companies at a time, again, working myself way more hours than was reasonable at any point in time. But I was having health problems. I was having relationship problems. I wasn't close with friends or family. All I was doing was working. And it was a really difficult, lumpy business. It was highs and lows. It was very profitable, but very lumpy. And what I found out, sitting down, being exhausted, being wiped out, 100-hour weeks, 80-hour weeks, I ran my numbers, and I found overall that 80% of, every time I'd been making money, I'd been putting that towards real estate for a long period of time. What I found was that 80% of my income was coming from real estate at a point, but it was only 5 to 10% of my time. So I'm sitting there going like, how?
Light bulb.
Yeah, like getting light bulb, or another word is getting hit in the head with a sledgehammer of important information. I was just like, I can't not see this. I can't unsee this, right? So I talked with our staff. We ended up selling those companies and putting it 100% towards real estate, which is a big place of where Saint's at today. But to be clear, real estate, it balanced out the company's income because we had been investing on the side. So in low months, real estate was saving us. In high months, we were putting more into real estate. That was extremely successful. And then on the other side, it gave me the fallback that I had other options. I had other income. So it's dramatic. It's a 10 out of 10 impact on my life, truly.
And what is the one thing that you know now about real estate that you wish you knew when you first started?
I would tell you, after seeing multiple crises and changes in the market that were dramatic upheavals where everything got turned upside down, it's that economics, just how insanely important economics is to real estate. Real estate's an asset class. It's part of a broader economy with different asset classes, different businesses. It is directly impacted by economics. So understanding the detailed economics that drive different parts of real estate can give you really good insights as higher likelihoods or lower likelihoods of things happening in the future. So that direct tie of economics to real estate has been one of the most dramatic things, more than I could have ever imagined early on.
And what is the one thing that sets the most successful people apart in real estate investing?
One of the things that I had the blessing to learn early on from people much smarter than me was opportunity cost analysis. So what you do today, everything that you say yes to, you're saying no to everything else. There's an oversimplification of that, right? It's understanding that in real estate, your dollar must be in the best possible place it can be, and understanding that when you invest a certain amount of money, you're saying no to all other investments. So a time calculus, how much time are you putting towards something? How much effort and energy and stress. And, you know, are you the professional or someone else the professional, someone better than you at something? I am one of the, I brag all the time about investing with our, you know, like competitors. They're all friends, right? But investing with our competitors all the time because they are better at certain asset classes than we are. The asset classes we compete in, we're the best. I will brag all day long. But the other ones, I'm like, there are people way better and way better asset classes that are really good, you know. So I invest with them regularly because I don't want to learn that asset class. I don't want our team to retool for that asset class. They have underwriting and tricks and experience that we don't have. I find that if I wanted to go compete with them in the market and I spent the money to go buy a comparable property, even if we owned 100% of that deal, our returns would be lower than passively investing with someone else. So that's something that opportunity cost is not just, you know, time. It's also returns can also be much higher working with a professional than somebody else. So we regularly utilize that. And I think that really smart real estate investors understand who the best is and they say, hey, can we do better than they can or can they do better than us? So we regularly put money with other groups successfully.
So Nic, where can our listeners find out more about you and what you're doing?
So we dig in a lot to economics. We try to give back a lot of free information because in our experience, the best investors we've ever worked with are the most sophisticated and have a basic understanding of the things that we put forward. So the smarter and more educated the investor, the better the investor is. We have our whole repository of tons of information and tons of webinars that we do on great topics at saintinvestment.com/resources. And it's basically all the webinars we put together on a monthly basis and a lot of their free materials that people can get access to.
Awesome. Nic, thank you so much for all your time and your insights today. Appreciate it.
Eileen, it's been really fun. Great to connect with you.
Thank you. You too.